This is The Journey, podcast edition. If what you're building didn't come with a playbook, you're in the right place.
Welcome back to The Journey, your builder's reference library for scaling smarter, adapting faster, and keeping your edge sharp. Today's episode is about tariffs, specifically the ones that got dropped like a hammer on international brands trying to sell into the United States a couple of months ago. So if your company imports into the US, your business model is a little bit, I don't want to say broken. It's absolutely not. Shaky. Yeah, not shaky either. Your business model is your business model. You know, you'll be able to carry on. But your cash flow, is probably a little bit tenuous, especially if you're a smaller brand. I would suspect that the CFO types, your accountant, those folks that work with your organization, they probably have some thoughts about all of this. I'm not going to put words in their mouth. I've got some thoughts about it, but it is what it is. We just got to carry on, right? So let's get into it. Early April, the White House made a sweeping announcement, a raft of new tariffs on imported goods. The floor is 10%, the ceiling over 50%, then it was 150%, then it was maybe 70%, then it was 2.5% with additional levies of 96%. You get the picture. It's unpredictable. And business does not like unpredictable environments. So, what kind of transpired in the month of April, a little bit into May, is there was a lot of posturing, and there was a 90-day pause announced on a lot of the tariffs. Recently, it's kind of settled into the U.S. has 55% tariffs on China, 10 to, I think 49% is the highest other tariff rate at this point on a host of other countries. And that seems to be kind of the normal for now. Some people are looking at that and thinking, wow, that's a win. They're not 150%. They're only 55% on China. Well, 55% is still, basically double what the tariff rate was in some of the highest categories of duties in the U.S. before that. Consumer electronics before that were about 29%. And that was pretty darn high. So 55 on everything, it's going to be a bit troubling. Now, if you're an international brand, what that means for you is that you've got to pay that money if you're importing your own goods into the U.S., like if you've got a 3PL or a warehouse or whatnot, you need to pay CBP that cash within 10 business days of importing those goods into the U.S. And that's a bit tricky, right? Like that can be a bit of a challenge. And that's why, circling back to your CFO or your kind of accountant type folks, they're probably not really loving everything right now when it comes to all of this. So this thing with the cash flow, it's not a drill. And if you're not already running the numbers on how this is going to impact your logistics, the impact on your cash flow, you're a little bit behind the peg. If you haven't started, start like right now. So let's bust a myth. And I think everybody who's listening to this knows this, but the wider public doesn't seem to, for some reason. Tariffs are not paid by the exporting country. They're not even really paid by the manufacturer unless the manufacturer is also the distributor and they have a company in the US that is importing those goods. Ultimately, tariffs are paid by you because the importer of record pays them and then passes those goods on to consumers down the value chain, whether it's an intermediate consumer, a buyer who's reselling it, or whether it's the end consumer. And those folks are inside the United States. So I just want to get that on the table. Tariffs aren't paid by the exporting country. They're paid by the importer, and the costs are passed on to consumers. The amount that you owe is based on the country where the goods were made, not where they were shipped from. And it only applies right now to tangible goods, physical stuff. Services and digital goods, exempt from tariffs. The tariff system wasn't designed to place levies on those, so they're not a part of that. Now, there are other taxes that impact digital goods, services. There are other requirements, but they are not tariffs. So that's another myth that I wanted to kind of throw out there and bust up a little bit. Like we kind of talked about, ultimately it's the end consumer that pays for tariffs. So of course, this means that US-based importers are going to absorb a lot of the initial new costs. And because they're going to have to be passed on, they're going to hit the price tag at the retail shelf. Higher prices, maybe smaller margins if you've got a very, very profitable product, or it could be a mix of both. I think for a lot of large companies, it's going to be a mix of both. The White House and this administration, they've been pretty clear about what's going on here. The strategy that they're really pushing publicly when they talk about it is build it in America. For most businesses, not quite that simple. Supply chains, especially complex value-added ones, they don't just pivot on a dime. You can't just say, okay, I'm going to stop making my products in country X overseas and open up a factory in the US. It just doesn't work that way. It takes a lot of time to migrate and rebuild a supply chain. And in the interim, it's very expensive. So even if you do onshore production to the US for a lot of these consumer goods, they're impacted. In the short term, the prices go up, even for the American-made goods. Labor is more expensive in America, but you've also got all of those costs that are a part of redeveloping a supply chain. When you're building a supply chain from scratch, you don't have an economy of scale to work with. So your costs for everything in that new supply chain are higher. Materials for your factory, inputs, components, everything. If it doesn't exist in the United States, it still has to be imported. And guess what? That means that it's subject to tariffs. You guessed it right. So what can you do as an international brand that doesn't really want to or doesn't have the resources to be able to open up a production facility in the US to get around all this stuff? One lever that you can pull pretty fast is how and where you warehouse goods. That's the tactical angle that we're going to be exploring today. How you can warehouse wisely and protect your margins and your cash flow during this period of uncertainty. So let's walk through three main options for non-US brands who sell into the US. Number one, you're going to warehouse it in the US. You're going to do kind of what you've been doing, make a few adjustments in your warehousing strategy to mitigate some of the impact to your cash flow. Number two, warehouse in Canada and really leverage some of the provisions of USMCA and integrated supply chains and transportation infrastructure that developed because of free trade in North America to your advantage. And number three, warehouse in Mexico. Same thing. Mexico is a part of the free trade agreement in North America, and they have a significant amount of distribution infrastructure that's been built up because of that free trade agreement. We'll talk a little bit about a fourth hybrid option too, but before we go there, a quick glossary of terms to make sure that we're all speaking the same language. So you've probably heard USMCA. If you're here in Canada, you've heard CUSMA, I'm sure. And for the folks in Mexico, TMEC is something that is probably thrown around quite a bit when talking about this free trade agreement. All of these terms, USMCA, CUSMA, TMEC, they mean the same thing. It's the updated NAFTA agreement. The names are different because it's convention for the country, which is signing an agreement like this into law, to put their country first. So USMCA is, of course, United States, Mexico, Canada agreement. CUSMA is Canada, United States, Mexico agreement. And TMEC is, I'm not even going to try to say it in Spanish, but that is the Spanish the Spanish way of saying the Mexico, United States, Canada agreement. Next term, 3PL. That means third-party logistics. Warehouses that you don't own, that you contract out to handle storage and delivery for you. Duty drawback. This lets importers reclaim some duties and taxes if goods are re-exported. Think of it kind of as a refund if the goods don't stay in the country which they were imported to, but you paid duties to bring them into that country. Cash conversion cycle. This is the time between when you pay for inventory and when you actually make money on it. Shorter is better. always in the cash conversion cycle. Section 321. Kind of funny to even be talking about 321 now because it's DOA, it's gonzo. But 321 was a provision of U.S. import law that allowed shipments under $800 to enter, $800 US, I should say, to enter the United States tax and tariff free. That rule CBP announced in January. It was going to be rescinded. They delayed the date until February, then until March, then until April, then until May, and then finally they did kill it off. So Section 321 is no more. Everything that enters the U.S. now is subject to tariffs, unless there's a very specific carve-out. And there are very few of those. Coming back to our scenarios. Scenario A, you warehouse in the U.S. That's your standard play. Bring goods into the U.S., you store them close to customers, you ship from domestic warehouses. Your advantages there are fast delivery times, simplified customs processes because you only have to file the paperwork once to bring in a container or bulk, not every time you send a parcel shipment. You're going to have lower last mile shipping costs because your goods are closest to the end consumer, and you don't have any import sales tax. The U.S. doesn't charge sales tax on imports because there is no federal sales tax. Downsides of this, you're paying the tariffs up front within 10 days, unless, very specific unless, you have a warehouse facility that is a part of the CBP's free trade zone program, and they have a bonded space in that facility. You also need a customs broker that knows what they're doing to take advantage of this on imports. But basically, the FTZ program allows you to bring in goods and store them in this bonded space and not pay the duties on them until they leave that bonded space, and you've got a clock of 4 years. So if you have all of the providers in the value chain in place that can do this for you, you do kind of quarantine your unsold goods from tariffs for a while. Challenge with FTZs is that they are a bureaucratic nightmare. They're managing the compliance paperwork for this program is a bit of a challenge. So smaller 3PLs tend not to touch it because it's such a hassle. And they also can't take out a lien against your inventory in the event that you go bankrupt or something to pay off their bill. So they don't like doing this if they're smaller. When goods are in a bonded warehouse in an FTZ, they're basically held there on consignment. Like, you still own them. Nobody else owns them. Like, you're legally responsible for them. 3PLs tend not to like that too much because then they have no claim against those goods. In fact, I think in a lot of cases, CBP has first crack at goods that are inside a bonded warehouse in the event that there's like a liquidation action or a bankruptcy or something. So 3PLs, they're not going to love this. Anyway, that's a little bit of a ramble, a little bit on topic, but off topic. Let's go back to cons of warehousing in the US right now. So you bring in your stuff, you pay the tariffs, they're sky high, and you got to float that cash up front until your product sells. So coming back to the cash conversion cycle, if your average time to turn over your inventory in the US is like 90 days, which for some categories is fantastic, that's really fast, you basically have to float the cost of tariffs that you paid on day 10 after import through to probably about day 120 to day 150 to sometimes day 180 if you're working with distributors that have net 90 terms. That's a long time. You don't want to get into that if you can avoid it, trust me. So the bottom line, in the US, you're going to get faster delivery, but you'll be bleeding cash on import duties unless your goods move lickety-split, like super, super fast. Scenario B, let's talk about that for a bit. This is warehousing in Canada. So here, you're importing your goods to Canada. You could be storing them in Toronto, Montreal, out kind of greater Vancouver area. If there's some industries where it's a little bit better to warehouse goods in kind of like Calgary or Edmonton in Alberta there. Sometimes down in Lethbridge too, if you're doing a lot of cross-border trade. There are some good warehouses working out of Lethbridge that if you're just focusing on the US and you don't really have a lot going on in the Canada market, Lethbridge is not a bad place to put a 3PL to have your goods in. So in this scenario, what you're going to do is you're going to hold those goods in Canada. You'll pay the Canadian tariffs on import, which are quite low. I think that the average of all of the duties that we impose under MFN rules, anyway, most favored nation, is about 8%, maybe a little bit more. So compare that to kind of like the U.S. doing between 10 and 55. It's advantageous, and 8% is the average. Most consumer goods have tariffs of around like 1%, 2%. Some categories are tariff free because we don't produce those goods at all in Canada. So why would we tariff them? Makes no sense. We wouldn't. So the duties and the tariff kind of structure is very advantageous in Canada. So, you bring your goods in, you pay CBSA, which is the Canadian Border Security Agency, our customs agency, the tariffs. They're due. Oh, I don't remember off the top of my head, but it's something like within the first business week of the next calendar month, you need to pay CBSA, the import duties. So you've got a little bit more time than you do with US CBP to pay the tariffs to start with, which is kind of nice. And then once your goods get bought by a US buyer, you ship them across the border. And that's it. So at that point, your US tariffs, duties are going to become due to CBP, but you've already sold these goods to a buyer. So you know that you have the cash flow coming back to be able to finance that. So from like your kind of CFO's perspective, that's a little bit nicer. It's a little bit easier to plan around that. It's a little bit easier to kind of like digest that problem if the only time you're paying the high US tariffs is if you have already sold the goods. And on top of that, you can also claim a duty drawback from CBSA for the Canadian portion of the duties. If you have an import account with CBSA, which, they're super easy to get, it's not rocket science, it's not a very involved process. You basically just submit a claim to CBSA saying, hey, I sold these goods to the US. I paid you guys 3.2%. Here's the value. I'd like my 3.2% back. And they just give you a credit on your account. So it's pretty easy to deal with. So pros of warehousing in Canada. Lower import tariffs. You've also got your potential to reclaim the federal sales tax, which we didn't talk about, 5% GST. That's assessed to most imports as well, but you can claim that back through input tax credits when you do your GST, HST filing, which if you're not, you should, because you're leaving money on the table, even as a foreign brand. Another pro, there's a well-developed cross-border logistics infrastructure. There are programs to help reclaim duties and taxes when purposefully re-exporting. So we won't get too much into this, but there is a program that CBSA runs, which is basically meant for certified distribution centers that only exist to move goods into the US. If you get set up with a logistics provider that has one of those designated facilities, you basically don't pay any sales tax or duties upon import. And you've got 3 years, I think, that your goods have to be re-exported to the US before they just say that the taxes and duties are owing on those goods. So it's kind of like a bonded warehouse, but a little bit more manageable, a little bit easier to kind of deal with if you're a company that's warehousing goods. Now, finding a 3PL in Canada that's a part of that program can be a little challenging, but once you do find one, everything's pretty well oiled. Like, it's easy to work with. Another pro of this, you can serve Canadian and US customers from a single inventory pool. That's nice. Talk to your finance people and say like, hey, if we were able to free up all of the money that's sunk into inventory for the US market in US market facilities and move it to Canada, would you guys like that? They will hug you. They really will. Minimizing your points of inventory can have a very, very outsized impact on your financial position if you can figure out a way to do it. So cons of warehousing in Canada and serving the US market. You're going to have longer delivery timelines into the US. There's no way around that. They're not going to be crazy, but you might go from, say, a 3 to 5 day SLA with a dual node kind of setup in the US to one that's more like 7 to 10 days. For some companies, for some brands, that doesn't really work. It's not acceptable. But for others, yeah, that works. And I tend to think that consumers are a little bit forgiving of some of this supply chain madness right now that's coming out of all this tariff war, trade war stuff. So it's something to think about. Your last mile costs are going to be higher. There's really no way around that. The goods are traveling further, more gas, more money. One thing to keep in mind about Canada is there are really kind of two coasts with deep sea ports. You've got deep sea port out at Vancouver, Prince Rupert, kind of that area. That's Pacific Ocean. Then there's one rail line that goes into, one commercial rail line that goes into central Canada. Conversely, kind of going the other way, if you're bringing goods into a deep sea port in Montreal, Quebec City, Halifax, same sort of thing. There's really one commercial rail line that's going into central Canada. That presents a little bit of risk in periods of terrible weather. So a couple of years ago, the CP rail line the link between Montreal and Halifax was flooded. And there were no commercial rail shipments on that line for about 7 days. It's rare, but it happens. So be aware of that as kind of a point of risk as you're considering warehousing in Canada to serve the US market. So kind of summing up scenario B, it's a little more complex logistically, but if it's going to be a huge win for your cash flow, you might want to consider it. It's something to really think about seriously, especially if you don't want to get into trying to do like the FTZ bonded warehouse stuff in the US. Going to Canada can be kind of like the next best thing. So the third scenario, warehousing in Mexico, kind of the same as warehousing in Canada, but from south instead of north. When I get this kind of going for clients, what we do is we usually land the inventory in Baja California near the port of Ensenada, and we store it kind of in that vicinity. That's kind of it's kind of pretty close to California in the US, which is huge market. That's the biggest consumer market in the US, if not the biggest, pretty close to it. I forget if New York's a bigger market, but California's a huge market. This port of Ensenada, it basically developed over the years with very specialized logistics infrastructure and import processes to serve companies, Mexican companies and foreign companies that were going to re-export goods into the US market. So the logistics infrastructure in that area around that port is fantastic. It's extremely modern, it's reliable, it's robust, and there are redundancies. I've never seen any issues with, at least with my clients, bringing goods into that port for re-export. It runs very, very smoothly. So pros of this approach, even lower tariffs than Canada. The average in Mexico is 2.69%. Now, there is 16% IVA, which is a VAT tax, a sales tax, that's assessed on imports. But if you get yourself set up correctly, and I would use a very smart trade lawyer based in Mexico for this, if you're going to be serious about it, if you get set up properly, that is recoverable. There's also a special program called IMEX that offers tax breaks if goods being brought into Mexico are going to be upgraded or reprocessed before export. So think about it kind of this way, and this is a silly example because you would never import avocados to Mexico. There's tons there already. But let's say you're going to import avocados. You bring your avocados into port, you have a little operation set up there, or you use a subcontractor. There's a joint venture or something involved in it. And you take those avocados, you process them into guacamole, and then you package it, label it, and export it to the US. That's kind of what the IMEX program is there for. And of course, some of the requirements really hinge around we're going to involve Mexican capital and Mexican labor. in that reprocessing kind of activity. So it's not like you can just bring things in, slap a new label on them, say that they have been reprocessed under IMEX and you're good to go. It has to be a good faith effort to substantially transform and add value to the product or the materials, add value to the materials to turn them into a product, to export them. That's kind of like the spirit and the gist of it. Cons for using Mexico to service the US market. The paperwork and the compliance, it is complex. It is very, very complex. If you put Canadian compliance requirements for import and re-export side by side with Mexican ones, the Canadian ones they're a heck of a lot easier to navigate. There's much, much less complexity. Though the current administration in Mexico has been making a lot of very positive noise about simplifying a lot of those rules. So, if we kind of had this conversation again in a year, it might be completely different. You never know. Another con, you've got higher last mile shipping costs and longer lead times into the US for the majority of the country, just like if you're going to do it from Canada. It's really as simple as like more distance, more gas, more cost. That's really the long and short of it. Now, the kind of exemption to that broad statement that I just made is if you have a huge customer base in like the San Diego area, shipping your stuff from Baja California to San Diego, as far as your last mile costs are concerned, it's actually really, really cheap. It's cheaper than shipping it domestically in the US. But San Diego and the northern part of Baja California, basically side by side. You can throw a rock essentially and cross the border. So it's pretty cheap. But that's an edge case. You're not likely to run into that unless you're just not going to run into that. So summing up this, it can be a pretty compelling option for some businesses, especially those with operations already existing in Latin America or with a strong Western US customer base where your last mile costs are going to be kind of mitigated a little bit just by the geographical proximity of Baja California to the Western US. All right, so the hybrid model, Canada plus Mexico. This really is not for the faint of heart. It involves managing, of course, multiple 3PLs in multiple countries just to serve the US market. For smaller brands, this is tough and think very, very hard before you even start exploring the feasibility of it. Essentially what you would do is you would serve the Western US from Baja California. So you would bring in your goods through port in Baja California and ship to California, Nevada, Oregon, Washington, and kind of the countries in the western portion of the Midwest. And then you would service the eastern seaboard and the eastern portion of the Midwest from Canada. Probably the best would be somewhere in the Toronto area. It's very close to road links. And then you've also got some secondary land crossings towards kind of the eastern portion of Ontario that can be fallbacks. But that means managing multiple points of inventory, which is going to add cost, and it means more operational complexity. Absolutely doable, but you absolutely do not do this without running a solid financial model and make sure the business case is there for it. And that's pretty much it. That's the rundown of strategies to try and keep your accountant with fewer gray hairs. So what's your move here? Well, you need to model this, run the numbers, look at your product mix, look at your unit economics, look at your sales velocity, look at your logistics costs. Make sure that all of this makes sense before you embark upon substantial changes. I have a Google Sheet template that's kind of based on some tools that I use. I'm going to drop the link to that in the show notes. If you are considering kind of running some of the numbers for something like this and you want to check that out, feel free. Copy it, download it, use it however you like. It can be a good starting point. Make it your own. Now, whether you store your stuff in the US, Canada, or Mexico, know this. Smart warehousing, it's not really just about fulfillment anymore. It's about survival. And that sounds super, super dramatic. Well, it kind of is, because the times are super, super dramatic. Business does not like unpredictability. None of us do, because all of the planning, all of the stuff that we've built, if we have to like whip around on a dime for no good reason, well, we don't really like that. So as far as business is concerned, this is dramatic. And leaking cash out the bottom of your supply chain and being unaware of it, that could be deadly. So I think all I'm trying to say, and I'll end on a little bit of a positive note, is keep an eye on things. You know, there's perhaps never been a better opportunity to reevaluate how you do business and to do kind of a top to bottom. Look at all the things in your business, especially supply chain. Make sure they're still working for you and that your underlying assumptions still make sense. Now might be the time. Thanks for tuning into The Journey. If this episode gave you something to think about, share it with your team. Don't forget to check out the link in the show notes, like I talked about, for our companion post, tools and downloads, all that stuff. And we will see you next time.
And that's it for this episode of The Journey Podcast Edition. If you're building something from scratch or scaling something messy, make sure to follow, share, or just send this to someone else in the trenches. Until next time, keep climbing.